Thank you, Dan. I've seen some of the questions come through, and I think the anonymity, being anonymous with this barcode or QR code, whatever, people are not holding back. So I'm going to call you by name and ask you to ask your question. No, so what I just want to do quickly is just a quick GM business update. Dan, the reason I didn't disclose you as a client is, confidentiality is something we take very seriously. So our clients have to out themselves voluntarily. But you won't hear it from us who our clients are. But some of them are in the room. So, yeah. They don't all get to speak, though. So just from a GM business update, I think firstly, the business continues to grow. So payroll, we feel it, 39 staff. Assets under management under advice at least, has grown to about 2.8 billion. So the company is getting to a level where it's becoming a lot more sizable, a lot more influential in the industry, and we have a bit of a voice now. On the asset management side, we're managing just over 970 million as at yesterday. So this was the number at the end of June. And then, as you know, in our industry, we have the Top Wealth Manager Awards. We haven't entered for a few years. We last entered in 2001, and we finished second, right across the board, including overall. And that just didn't make sense to us, that somebody else kept on finishing first. We always were second, but we were still second overall. So we were sulking. We were 3 years sulk. But anyway, we came back this year, and we won Top Wealth Manager for executives, People's Choice's Top Wealth Manager for the 4th time, and then we were ranked second for the Top Boutique Manager. Thank you. And just to give you a sense of what we're working on at the moment, so a couple of projects. We're working on family office project, launching a family office. And there are two big drivers behind that. The first driver is just what we're seeing coming out of SARS. SARS is becoming a lot more aggressive, a lot more specific in terms of disclosures that they want, particularly from trusts, particularly from high net worth earners. So a lot of our clients are going to be impacted. Some of those legislations becoming effective in September. And then on the fiduciary services side. So in terms of setting up trusts properly, in terms of ongoing management of trusts, governance, tax, the whole lot. So some of the people that we're appointing, not financial planning experience, but more trust and tax experience. So those two projects, Kagisha is running with, and hopefully we should have some communication for our clients on that front. And then on my side, working on our global fund. Been to Mauritius twice this year. Didn't come back with a suntan at all. It's inside the office the whole time. We're launching a global fund. It actually makes a lot more sense for us to run it out of Mauritius than out of South Africa. If we run it out of South Africa, we're limited to Section 65 funds and funds that have been approved by the local authority. Out of Mauritius, we've got a much bigger universe, and we can add a lot more value to clients in terms of capital gains tax protection, accessing significantly cheaper funds, and accessing funds that clients don't have access to from South Africa. And then we're working on a passive fund offering. So with our funds that we're currently running, what we've picked up is that the asset allocation, the strategic asset allocation that we're running, when we compare the performance of our asset allocation to some of the passive managers, our performance actually ranks quite strongly. So, sometimes you start a business with one idea, and when you're running it, you see other opportunities. So we'll be hopefully bringing that to our clients shortly. So just very briefly on the asset management side, so we launched 5 risk profile model portfolios in August 2019. So that was 5 years ago. The aim was to implement, and it still is our rationale for running our own funds, is a consistent application of our investment philosophy in a growing business. So as GMI has been growing, we've had other advisors join the business. It's important that we're able to apply strong risk management and have a consistent investment philosophy being applied for all our clients. And then also we have a fairly busy clientele. So when you want to make switches, when you want to make changes, you know, you can't get older people to sign paperwork. And you guys don't like paperwork, generally, from our experience. So anyway, we've converted 3 of our model portfolios to funds. So they're fully fledged unit trust funds. And so they now have a 3-year track record. And our model portfolios actually 1 week short of a 5-year track record. This is how the business has grown. So as I said, as of yesterday, we're sitting on 970 million assets under management. This was the quarter-end report. And yeah, so clients largely invested in the 3 unit trust funds, the cautious, moderate, and growth fund. The moderate fund, the most popular with our clients, and obviously given you know, our client profile, it's the one that tends to be the most suitable for clients. And yeah, also coincidentally happens to be the one that's performing significantly well or better in its category compared to our other funds. The others are doing very well, but that one is just, it's been exceptional. The fund was ranked first in its category the end of January, February, and March over 1 and 2 years. So yeah, that's helped. So yeah, just briefly, if you look at the asset allocation of the funds, as you move from kind of left to right, I don't know, is it left to right on your side as well? That way, towards the door. The funds increase in risk. So a lot more equity exposure, a lot less bond and cash exposure. So you'll see that the income fund, absolutely no equity exposure locally or offshore, whereas the worldwide flexible fund or model, 80% equity, local and offshore. When we look at the performance of the fund, so sorry, this is the full extent of my PowerPoint skills. When I looked at it, it was just like a whole lot of numbers, and I thought, like, I couldn't make heads and tails. So the top line is the fund, the bottom line is the sector average. So that's the income model with the sector, the cautious model in the sector, the moderate and sector, growth and sector, and then worldwide flexible. And I think consistently you see that we've outperformed sector. Over the last year has been pretty good. Some of our managers have really outperformed, but also the asset allocation strategy that we have in place has helped quite significantly. Over 3 years, it's a bit closer, but still outperformance. And then since inception, as I said, since inception is 5 years for the model portfolios and 3 years for the funds. So all sitting comfortably in the top half, outperforming sector average, and quite nicely outperforming in the shorter term. What I do want to talk about now is the flexible model very quickly. The reason I want to talk about the flexible model is that we're in the process of converting the flexible model to a fund. And the reason we want to do that is that the flexible model, as a model portfolio, when we make changes, that triggers capital gains tax. So we've only been limited to using the flexible model portfolio for our living annuity clients. because in a living annuity structure, there's no capital gains tax. However, given the performance of the flexible fund, it actually has a lot more appeal with discretionary money. So, this, unlike the other two funds, and unlike, as CPC spoke about, Alan Gray having a downside awareness, with this fund, we are actively looking for return. We're actively looking for opportunity. And so that's why you see the kind of performance that it's delivered since inception. It's been a really strong performance since inception compared to sector, and that line is the benchmark, which is inflation plus 5% per annum. So we believe by converting it to a unit trust fund, we take away the CGT issue and make the fund a lot more suitable for different types of investors. This is just the fund compared to the Johannesburg stock, the JSE All Share Index. So typically, a high-risk investor would be invested in equity. What this shows, so the top line is our worldwide flexible fund, the bottom line is the All Share Index. What that shows is the value of diversification, one, and it shows the value of active management. So diversification, we are able to offer better downside protection than a pure equity fund, but capture quite a bit more of the upside as well. So yeah, we'll be talking to you probably in the next 2 months. Our application is with the authorities at the moment, with the Financial Sector Conduct Authority, and we should be launching that fund in the next 2 months. So we'll be converting the flexible model to a flexible fund, and we think it has a lot more appeal to our clients. Two-pot. Has anybody heard of two-pot? Okay, so what's cooking in the retirement space? Up in place, yeah, two-pots. Cool. So two-pot is coming into effect at the end of next week. Well, the Sunday, the Monday, the 1st of September, two-pot comes into effect. Okay, and the question always is, when you have a change of policy, is it a better policy than what was previously in place? Is it a better system than the incumbent retirement planning or the incumbent retirement system? I just want to get a sense from the audience. Do you think, from what your understanding of two-pot is, do you think that it is a better system than the previous one? No. So, the motive. Okay, that's a very good question. Why are we changing it? Why are we moving to two-pot? Well, what is the motive? Yeah. Yeah. Right, so I think that question is important. Why was it brought into being? Treasury has been on a retirement and savings reform process since the mid-2000s. So this is just the continuation of a 20-year program. Part of that program saw the introduction of tax-free savings accounts. That came out of that program. Another thing that came out of it was the harmonization of pension and provident funds. So since 2021, provident funds behave exactly like pension funds. And two-pot was kind of the next leg. Is it a better policy? There was a lot of people saying no. I didn't see anyone that thinks it is a better policy than the system than the previous one. Okay, industry people, hands down. No, okay. It is a better system. It's a much better system. Okay, what this graph shows you, the top line shows you a perfect world where somebody starts working on day one. They contribute to a retirement fund for 45 years, and they never withdraw, and their money is always invested. So this is someone earning 100 Rand a month. They will retire with 1,800 per 100, right? The current system is people are retiring on average with 600 Rand a month. So with the current system, you have no access to your money when there's an emergency. But when you change jobs, you have access to all your money. And so what happens is when people change jobs, they take their money with good intentions to pay off debt and save more. They sometimes pay off debt, but they never save more. And so this is the reality, is that 6% of people are able to retire under the current system. What two-pot does is it takes us significantly closer to the best possible ideal. And when you're developing policy as government, you're looking at a high level. Does it give a better outcome? And as a policy, it does. This thing that, you get access to money and you get taxed at capital, not at income tax rates, you shouldn't be taking money out of your retirement in any case. But when you go into retirement savings, you get a benefit at income tax rates. So now you're getting penalized at the very same rates. Okay, so government incentivizes you to save for your retirement. You're taking money out, so you're not saving for your retirement, so they're taking that incentive back, right? So two-pot essentially is a four-pot system. Okay, so the reason there are 4 pots is that one of those pots is actually 2 pots. So if you're in a provident fund, as I said, 2021 there was harmonization. Provident funds became like pension funds. So up until 2021, your vested benefits, those stayed. When you retire, you can get all your money out of that pot. Everything since 2021 that behaves like a pension fund, you can only get 1/3 out. Okay, so those 2 pots become 1 pot. Okay, and going forward from the 1st of September, if you're contributing 10,000 a month to your retirement, 3,000 will go into what's called a savings pot. 2/3 or 6,600 will go into a retirement pot. Okay? Right. Okay, so that's 2 pot. What's going to happen is they're going to take from your existing pot up 10% of your capital will go into a savings pot, but that will be capped at 30,000. So if you've got R1 million in your retirement fund, 10% is 100,000, only 30,000 is going into the savings pot. Okay? The balance stays exactly in your vested pot. So I feel like a chef talking about all these pots. But anyway, so the balance stays in your vested pot. There, that will be treated after September the way it's always been treated. You've got full access to that. When you change jobs, you potentially have full access at retirement, or at least 1/3 if it's a pension fund or retirement fund. Your savings pot, let's just say a year later you've been contributing, your savings pot grows to 70,000, your retirement pot grows to 80,000. If you change jobs at that point, you can access your vested pot, you can access your savings pot, the retirement pot you can't touch. Okay, you absolutely no access to that. When you get to retirement, you have no access to the retirement pot at retirement either. It must buy you an income. Okay, so that retirement pot, I think, is the source of a lot of people's unhappiness. But when you think of it as a policy, it's going to result in more and more people being able to retire with much higher incomes. Okay, so your options are when you change jobs, you can either withdraw your entire vested pot, you can withdraw your savings pot, you can't touch the retirement pot. You can leave the vested pots where they are if your company will allow you to. You can leave both the savings and the retirement pot where they are if your company allows you to. Or you could move it to a preservation fund together with your savings pot and your retirement pot. Okay. So just to kind of, in a nutshell, it's a better policy. It's going to lead to much better outcomes. And if you think about that savings pot, I mean the retirement pot, it's long-term capital. When Dan needs more money to build another power station or some new technology that he was talking about, that retirement pot there becomes a very powerful source of capital for the country as a whole, because you can make much longer term decisions with that money. So yeah, those retirement pots, starting off small, 10 years from now, potentially it's a significant game changer for the country. Your economy, your savings system supports your economy, and your economy gives you your returns. I don't have access to both my hands right now, but the one hand washes the other. The biggest risk is the impact of withdrawals. It's understanding that accessing that money. Okay, so this is a typical person under the current system. Annualized investment return of 11%, contributing rate of 11%. We assumed salary growth at 3%, and that they change jobs every 7 years. When they get to the age of 50, they realize that actually retirement's around the corner, and so they behave a bit better and protect or preserve their funds. And yeah, so in that system, people are retiring with 2.7 million capital under this scenario. If we assume that she draws her funds and she draws from a savings pot, this shows the impact of two-pot. Is that just because she's forced to preserve 2/3 of her contributions, she's already going to retire with 3 times more capital than under the current system. Okay, so savings, two-pot is a much better system. Okay, if she just withdraws the savings, but she leaves a vested pot and her retirement pot, she'll retire with 14.8 million. And if she preserves everything, there we go, the 19 million. So 7 times as much capital than if she would, if she behaves like retirees or members of pension and provident funds behave at the moment. Okay. So, sorry, Tate? Like teachers, like everybody. We don't want to pick on any profession. But yeah, typical of retirement fund members. Cashing in money, not preserving for retirement, not understanding the impact. It's just under two-pot. When you now cash in money, it's going to be taxed at your marginal rate, not at your average rate, and not at the withdrawal tax table rate. It's at your marginal rate. So if you earn over R1 million, minimum 41% is going to go to tax. It's quite punitive. Okay. I hope we've covered everybody with the thank yous. Thank you for your time. And yeah, we're going to go into the Q&A session now.